The glass was well and truly overflowing today as investors raced back to the share market. The Australian market's biggest rise since December 2008 was built on hopes that Europe was finally coming to grips with the scale of its debt problems. Here's Philip Lasker.
The optimists are rushing back to equities with a vengeance, sending the Australian market up more than 3.5%, the biggest rebound in almost 3 years. It was optimism built on signs that the Europeans are beginning to grasp the global implications of their inadequate response to the building sovereign debt and banking problems.
Die deutsche Bundesregierung, das hat der
Germany is ready to recapitalise the bank and we need unitary criteria. We are under pressure of time and we need to take a decision quickly. If we need to discuss this with the European Council, we are certainly prepared to do that.
There were also hopes the European Bailout Fund, the EFSF, would be given more firepower with an ability to invest in secondary markets with the support of the International Monetary Fund.
The IMF could invest alongside the EFSF. There are many other possibilities that are now opened up by this new model for the EFSF, which we could envisage, and we would certainly be ready to play that role.
In the eyes of many investors, given the events of the past few months, the IMF has more crisis management credibility than the Eurozone.
Any investment that we would make in Italy or in Spain, for example, would be based on full confidence that those countries are on the right track, that they're solvent and that they're taking all the measures that they should.
And what of Greece? The IMF has offered its conditional support to a second Greek bailout package, but Managing Director of Nomura International, Alastair Newton, says Greece is likely to fall short of its commitments to sell off assets.
Now, at that moment, you're likely to have a situation where the IMF is going to balk at disbursements, and if they balk, the Dutch have already said that they will not pay unless the IMF is paying.
And Australia's banks will be hoping the global concern subsides because it looks like they'll soon be paying much more for their money on nervous world markets.
When the wholesale funding that is maturing in the next 3 to 6 months has to be refinanced in the wholesale market or alternatively funded out of those excess deposits, we think that'll be the trigger for either reductions in the level of competition that is coming through on the product, or conversely, potentially, the out-of-cycle rate rises may factor back into the equation.
Is it any wonder the Reserve Bank could possibly be preparing to cushion the blow by cutting the official cash rate?